Why shouldn't you regard low margin requirements being flaunted as a selling point by some providers? CFDs have lower margin requirements than other types of leveraged vehicles. Gearing or leverage is the degree to which you're able to make use of borrowed money. Here's one thing to keep in mind. The lender, that's your contracts for difference provider, is focused on maximums, but you, the borrower, should be concerned with minimums. Borrow as little as you can, but still getting bang for your buck. Now, let's turn to your CFD trading account. You want to increase your speculative capacity by leveraging your capital, so you borrow money from your broker to trade with. Before your CFD broker will lend you money, you have to put down an initial margin amount. This will be used to lever with. Your CFD provider, being a prudent businessman, has calculated his risk beforehand. He's quick to tell you about the maximum amount he is willing to let you borrow from him. In contracts for difference, this can range from anything between 5% and 90%, depending on the volatility and liquidity of the underlying market. Margin is usually expressed as a percentage, while leverage is expressed as a ratio. This doesn't mean that you should use all your borrowing power with your CFD broker. In fact, it would be highly imprudent for you to do so. The marketing wizards at CFD broker houses know that offering clients very high gearing ratios works to their advantage in their quest to attract more online investors from the traditional markets. Also, the portfolios of many online investors' portfolios were devastated by the 2008 crash. Losses of more than 50% of formerly lucrative stock portfolios became commonplace. As a result, today we have some providers shouting from the rooftops that they only require a 3% margin up front. In reality, the CFD broker is simply stating that they will allow you to gear at the absolute maximum if you utilise all the borrowing power from your broker. But you must remember that gearing is a double-edged sword. It can work for you and against you. Leverage is not what your CFD provider will allow you to use. It is what you decide to use. The prudent application of leverage cannot be stressed enough. Most CFD brokers will tell you how much gearing they will let you have should you wish to, but not how much you should leverage. Even if you were to find a provider with the lowest margins, just keep in mind that regardless of how little initial margin you pay up front, you are always responsible for the full market value of the trades you execute. Paying less deposit margin up front simply means that smaller price fluctuations can have a bigger impact on your trades. For example, imagine a stock CFD that requires a 5% margin to open a trade. If there's a 5% increase in the market price of the underlying stock, this results in a stunning 100% return on the investor's capital. However, this cuts both ways. There would only need to be a 5% fall in the market price of the share to leave you with a 100% loss. Let's assume you have an open trade and the market moves against your position. The CFD broker may ask you to put in additional funds to keep the trade open. If you have excess cash in your trading account, this additional margin will be automatically deducted. In cases where you don't have sufficient money in your CFD trading account, the CFD broker may make a margin call demanding more funds. Statistically, overgearing is the main culprit for blowing out accounts. You should keep your share sizes consistent in all CFD trades. Don't be tempted by a perfect setup and then over-leverage yourself on that trade. Keep in mind, even the most perfect-looking trade can go wrong on you in a split second.